Hey everybody, it's Patrick Moore with Ironclad Wealth Management here, and today I've got a quick video kind of peeling back the curtain on what I would call our tax planning philosophy. And I've subdivided it into three key areas that I think that everybody who watches this video can apply to their small business tax planning. Now, it is a situation where this is going to be general information, but I think that's good because what it'll do is you can take it, adapt it, update it. You don't have to necessarily work with us to utilize this information. So, as this slide here says, there's going to be projections involved in this presentation, and it's not specific tax advice. Take it, adapt it, view ideas and tax strategies through this lens. And although we're going to show you some specific examples of how these three things could work, they're not individual information. Now, I think most small business owners, they kind of have this rite of passage, right? They sit down, they've really struggled to build the business, they spend a lot of time, and taxes aren't at the top of their mind. That first year you turn your first big profit. And like it says here on this slide, you sit down and you have that oh shit moment. You sit down, you get your first business account, and maybe you plug it into TurboTax, and the number that pops up, you go, hey, it can't be right. Oh, do I need to find more mileage? Do I need to find some more deductions? What can I do? And by the time you've gotten to that point, it's too late to do many things. So the good part about that is that it's totally avoidable. So what tax planning is tax planning is avoiding that situation. It means understanding how your business income translates into taxes, and that's what we're going to talk about today. Now, most business owners' first experience with taxes is that situation I just mentioned. You go from having payroll withheld, you go from having it kind of done for you, you fill out your W-4 and that's it. Nobody really knows what the W-4 does, but you're like, hey, I'll just see where I wind up. And then you move to a situation where you don't know what your expenses are going to be. You don't know what your employees are going to do. You don't know how much revenue you're going to have. And most small business owners only work with their accountant at the end of the year and they say, okay, here's how much you're going to owe. And that's looking into the past, right? So tax preparation is sitting down, looking into the past and saying, okay, what do I need to do and how much do I pay? But by the time that year has closed, you can't actually do many things to minimize your taxes. So tax planning is a sibling to tax preparation, and really you need both to achieve the best results. Tax planning means sitting down at the beginning of the year, forecasting your kind of projected incomes, and then identifying things you can do to lower said taxes. Now, our framework and the track that this video is going to follow today is a three-step process. And so there's three key things I think every tax plan needs. And you can adapt this and maybe add a fourth or a fifth key to yours. The first is that tax planning has to be proactive. It's not tax preparation, which is vitally necessary because it has to make it onto the returns properly. But you need to look into the future. You can't wait for something to happen and then go, oh, what can I do to save taxes on this? That doesn't work. The second is that it must emphasize your lifetime taxes over short-term taxes. Meaning you get to the end of that year, you start scrambling, you're like, hey, how can I find some mileage? How can I find some deductions? What's going to happen is there are years where it makes sense to pay more taxes. And because when you pay more taxes that year, 20 years down the road, maybe you'll save $15,000, $20,000 taxes by paying $3,000 more in taxes that year. That's not a real number, right? That's just an example. But if you look at it for the long term, you will achieve better results. And then finally, this is a little tongue-in-cheek, but I think that everybody knows it can get lost in the shuffle when you're like, oh, this thing sounds really great. And that's keep it legal. Because if you don't keep it legal, you're going to have a storm cloud over your head. You might get in trouble. And like we said, there's even some unintended consequences that if you get in trouble, you may not have considered when you're like, oh, this idea sounds great. Before you implement, and this is something I'll say no matter which part of your finance it is, before you just get sold a tax strategy, you need to have a framework, you don't need to be in a rush, and you need to have a plan. You need to see how that strategy fits into your plan, and by following this framework, you won't be in a rush, and it will reduce the chances of mistakes. So the first area is, and the first key to good tax planning for small business owners is being proactive. What does that mean? It simply means that the IRS has deadlines, and you need to plan before those deadlines. The first one that everyone has every year is December 31st, or whenever your fiscal year ends for your business. You know, if you have a business that ends June 31st, June 30th, that would be your fiscal year. Now, Before the end of the year means you can't sit up, oh, my taxes are due April 15th, and on February 1st start scrambling. You really, on February 1st, need to be planning for that year. So February 1st, 2025 is coming up. Have you projected out your income for the year? And you have to make some assumptions, right? But say, okay, 2025, I'm expecting $560,000 in income, net profits. What can I do? And then when you develop that framework, you might come in lower, you might come in higher, but then you'll know, because you've developed a framework, how your taxes will change and which strategies maybe become more viable or not. And the kicker is, some strategies you just can't do after the end of the year. The second one is that maybe you're selling your business, maybe you're selling some real estate, maybe you're selling a stock. If you do some planning before that sale, you have a good chance of lowering your taxes on that if you kind of, understand what you're going through. And then finally, before you start your business, that can even have an impact on how you incorporate, how you operate, and what your plans are long term. So before an event is when you need to plan, because by January 1st, it may be too late. Because I have some examples here, and this is just some generic information here, but let's say you're making $1 million, you live in Georgia, that's where I'm from, and these are a few strategies that if you wait until after the end of the year, you cannot implement. It's only 4 or 5, and these are just ones that came up real quick off the top of my head. Who knows how many the real number would be depending on your individual situation. One would be your employee deferrals in your retirement plan. That's an easy $10,000 if you're in the top marginal tax bracket. S corporation elections, which may not work for everyone, but if it does work for you in this situation, going from LLC to S corp would save a significant amount of money, because fast forwarding, not only would it save you money on Social Security taxes, it may unlock some QBI deductions because now you're paying yourself a wage if you don't have any other employees. And then finally, the state PTED elections typically aren't available after the end of the year. So there are all sorts of different things that you need to be aware of. And I'm not saying these all work for you, but if you don't plan ahead, you would have lost out on tens of thousands of dollars in tax savings. So if I can drive home one thing today, it's plan ahead. So if you need to figure out, okay, what do I need to do to develop this framework? Well, I think there's a few steps. There's a few steps you need to take. The first, like I said earlier, establish that baseline. If you don't have a baseline, you're going to be kind of flailing. Once you establish that baseline for your business income, use some tax software to establish projections. Or your accountant or tax planner can probably assist you with that, or not probably, they can assist you with that. But obviously it depends on kind of your individual situation and if you even have an engagement for that, right? Because it may be an additional fee. 3, analyze strategies and their savings based on your expectations. Then what you need to do is review your withholding for the year, review your safe harbor, set up your estimated payments, and then monitor and update it throughout the year. Now that you have a framework, you can adjust it and change it. So you can add in and adjust your steps, but I think the hardest step there is step 3, because you have to be able to make those changes on your own or engage somebody who can. Now, the second key to good small business tax planning is lifetime tax planning. Because like I said over and over again earlier, if you make short-term decisions, you'll get short-term results, and short-term results are not always good. They may feel good in the moment, but you may rue that decision in the future. There's a few easy examples we can look at here. The trade-offs between a pre-tax 401k and a Roth 401k. Investing in a new truck or business, this is a classic one. This is one that is my pet peeve. If I had to put one thing on anything, right? It is somebody who calls me in November or December, they're like, hey, I'm going to owe a bunch of money in taxes. Should I buy some big equipment? And I'm like, well, do you need the equipment? Is your business going to need it? If not, you're just buying a depreciating asset that's not actually going to benefit you long term. So I hate that one. Anyway, I got off on a tangent there. And then third, if you have any real estate, cost segregation, what that does is it accelerates your depreciation. Could be good, could be bad. If you're in a low income tax year, it could be terrible. So monitoring those and weighing the pros and cons over the long term is a huge, huge factor in any plan. And then finally, I'll show you an example here of how you incorporate your business. Now, I do want to say, like I said earlier, these are purely examples, right? They're not real numbers. But if you look at this, let's say okay, Patrick, I'm going to start my business. We're going to go into business, and here's the kicker. We plan to sell the business. Me and my buddy have a great idea. We are going to put it into production and we're going to sell this to a private equity firm in 10 years. That's our plan. We want to retire. We don't want to run this the rest of our lives. But that's a key piece of information, because when you go about setting up that corporation and you're making, let's say, $500,000 a year, on you and your friend, you may owe $100,000 in income taxes as an S corporation. However, you may owe $150,000 as a C corporation. And when we're talking about that short-term tax planning, you're going to look at that and say, well, what am I paying today? It's income taxes. And so you're going to choose the S corporation. But if you look at it for the lifetime planning, if you have a C corporation and you utilize a few different strategies, you could potentially eliminate capital gains taxes. So if you sold that business for $4 million, and you can see some of the more figures of this on our blog that'll be linked in this, so feel free to check out some of the information. But in Georgia, it'd be about a 25.39% tax rate, which on a $4 million gain, so I'm saying a $500,000 business at an 8x multiple, would be about $1 million in taxes. But if your business qualifies as a C corporation from the very beginning, you could utilize that qualified small business stock exception, or exclusion, sorry. And what that does is it would eliminate your taxes. Now, that doesn't mean that it's going to work, because there's certain industries that can't utilize it. There's certain rules related to assets. But let's say you go 10 years before your sale. Well, the S Corp saves you $50,000 a year. So that's about $500,000 in savings. But if you utilize the C Corporation, you would save $1 million year 10. So you would actually save about $500,000 by utilizing a C Corporation in this example. Now, here's the kicker, right? Is the bird in the hand worth the two in the bush? Maybe. Do you think you'll actually be able to sell the business? Maybe, maybe not, right? But being educated and looking at this information, understanding that the lifetime tax reduction is the goal, because that's what's going to build your net worth the most, rather than the short-term tax reduction, is just what I want you to kind of recognize here. Now, there's a few steps you need to take, once again, to kind of build this plan. It's first, like we said, you need to build that projection like you did on the proactive section to analyze what your income is today and build that projection. Then you need to have an idea of when your income's going to stop. Am I going to retire at 55? Am I going to sell at 57? Or am I just never going to retire and pass this thing down to my family? Well, then, maybe the income tax savings are a little bit better. And then maybe you need to think about estate taxes, right? And then if you have some periods where you sell the business and your income's lower, well, is there any way you can shift income from your higher earning years into your lower income earning years, right? And then the most important part is, like I mentioned with the software previously, how are you going to model these decisions, right? Because you can kind of guess at it and maybe be directionally accurate, but it's nice to have an idea. Now, it's impossible to get it exactly right, because we're not talking about a 1-year decision. We might be talking about 10 or 20. But directionally, you can have a good sense and feel more confident in your small business tax planning. And then the final one that I kind of mentioned was tongue-in-cheek, but is maybe more important than the other two, right? Is keep it legal. It might be fun until you get caught, but if you get caught, you might be in trouble. And here's the thing. It doesn't mean you have to be audited to get caught. Let's say you go use some fancy tax strategy you hear about at a dinner or a seminar. Well, guess what? If the IRS pins that promoter, guess what the first thing they're going to do is? They're going to get their client list. So if any of the other clients of that firm are actually in that same thing and they get audited, you might get caught up in that same storm. So keep it legal, because one of the key things that I love about tax planning is that if you do it right, it lowers your stress. Not only does it lower your taxes, but at the end of the year, you're not rushing. If you do some things that are, maybe not aggressive, but actually illegal, you're probably not going to sleep well at night. Now, some people are super aggressive. Maybe they have different attitudes towards this. But I think that keeping it legal is an essential part of any tax plan. And so a few questions to kind of vet somebody, and if you're not sure about a tax strategy, which, if it doesn't fit into your plan, don't do it at all, right? But here's a few. Hey, are you getting a plan, or is it a specific strategy? Are you paying that person for a plan, or are they going to get a percentage of whatever tax savings you realize? I think CPAs can't even do that because it's called a contingency fee. People got in a lot of trouble with that recently with the employee retention tax credit. But if anything like that is being pitched to you, that would raise kind of my red flag, right? A big one would be, is the strategy on the Dirty Dozen list? Does the person selling you the strategy have a clean track record, whether it be criminal, civil, or if you're a financial planner, on the IAPD or the SEC broker check? What due diligence is there? And I think this is a big one. Um, is the person confrontational to your other advisors when they're trying to understand the plan? I think that's a big one, right? And then I think complexify might be a funny word right there. Does it complicate your life? Because if something unnecessarily complicates your life, it may not be worth the tax savings. So just kind of think about this as you vet those strategies, answer those questions, and keep it legal, because there are significant penalties on here. You can get up to $100,000 if it's actual fraud, plus an underpayment penalty up to 75%, plus a casual 5-year stay in prison, right? And I think everybody understands that you're going to get penalized if you get caught. Something I don't think everybody realizes is that you don't have to have the IRS catch you. It could be another business owner or a private equity firm that catches you. What if you're trying to sell your business and that firm and their due diligence finds an issue? You don't have to be caught by the IRS. They can catch you and say, not a chance in hell we're going to pay that amount for a business that has outstanding legal and tax risk, right? So what's going to happen in that situation is maybe you're unable to sell your business when you want it. Maybe you're not able to sell the business for the value you thought you're going to get. But that's a huge risk that I think a lot of people don't fully realize when they're considering these plans. And it's something that you kind of have to ruminate on. So I thought this was going to be like a 5 or 10 minute video. It went to 15 or 16. Maybe I'm just a little long-winded. But I hope you found this helpful. Like I said, it's just a framework. Hopefully you can, review it, analyze it, see what you think. But if you do have any questions and maybe you're looking for tax and financial planning, reach out to us, ironcladwm.com. You can check out the blog. It's got a little more breadth to it on this topic. But this is our philosophy, and I hope that you really found it enjoyable, and have a great day.